Hello, this is Nicole, and this video is about the put debit spread, otherwise known as the bear put spread. This video is for educational purposes only and not investment advice. The bear put spread is a bearish debit-based option strategy, and this one's a good one to know. It allows you to take a bearish viewpoint on an underlying stock without having to short shares or purchase puts outright, which can leave you vulnerable to changes in implied volatility and time decay. It's constructed by buying one put option at a higher strike price and selling one put option at a lower strike. Both options have the same expiration date, and the result is a net debit, and that's your maximum potential loss. Let's move into the tastytrade software here, where we can look at a very practical application for the put debit spread. As you can see, I am long 320 shares in my IRA account, and I'm sitting on an unrealized gain of over $22,000 on the position. And you can see here that QQQ has been on a tear over the course of the last few months. And I am interested in hedging the position through the first quarter of 2026 because I'm concerned that we might get a market pullback. Let's head over to the table section of the software here. And I'm going to scroll down to the March 31st, 2026 options expiration cycle. That should give me coverage through the end of the first quarter here. Those options expire in 145 days. And I want my protection to kick in at anything below a 5% sell-off. And I want the protection to last down towards 20%. So I want protection between 5 and 20% to the downside. So we take the current market price of the Qs of 624 and multiply that times 0.95. So a 5% sell-off would bring us down to roughly $592 per share. And that's where I want to purchase my put option. So protection would kick in around $590. Now let's calculate what the value of the Qs would be on a 20% sell-off. And that's going to be the option that I sell against the 590 put. And that gives us a value very close to 500. So let's scroll down to the 500 strike price and sell that one. And I could collect a minimum of $4.63 to sell that one against the long put. And that completes the spread. It's a 90-point wide spread. That would cost $13.60 if I were to execute that order and it got filled at the mid price. Max profit is equal to $7,640. Max loss is $1,360, and that equals the buying power effect. And of course, that would be a debit in my IRA account. And let's head over to the profit and loss analysis section of the software here. And I'm going to deselect the shares so that we can just take a look at what this structure looks like from a profit and loss diagram perspective. And we can see that the position loses money if Qs were trading above the break-even price at expiration, with max loss capped at $1,360. The position makes money if the Qs trade under the break-even price at expiration, and maximum profit is capped at $7,640. Now, this is a one lot. If we were to buy 3 of these to protect the 320 shares in the portfolio, we can see here that the max loss would be $4,080 and the max profit would be $22,920. So calculating the break-even point for a put debit spread is straightforward. It is the long put strike minus the debit paid. So in this example, the break-even point is $576.40 per share. And max loss is equal to the debit paid. So in this example, the max loss is equal to $1,360. And the formula for calculating the max profit is taking the spread width, which in this example is 90, and subtracting the debit paid. So in this example, maximum profit is equal to $7,640 once we multiply everything times 100, because we know that equity options have a 100 multiplier. So let's head back into the tastytrade platform here. And this time, let's take a look at what that position would look like whole. So I've got the 320 shares of the Qs, and I'm sitting on an unrealized gain of $22,500. And that's what the position looks like unhedged. And you can see that if the Qs were to sell off from the current market price, the position would lose value unabated, which would be unfortunate. Now let's head over to the table view, and this time we're going to include that put debit spread that we built just a few minutes ago and take a look at what the position would look like in the profit and loss analysis software. So we have the 320 shares there, and I'm going to populate the potential put debit spread order. Let's head over to the analysis section of the software, and we can see how different that graph looks. So you can see here if the Qs sold off, the position would decrease in value. However, between a 5 and 20% sell-off, we would see a bit of a break. So the overall position that is now profitable by $22,500 would still maintain a profit of a minimum of $6,000-ish if the Qs were to sell off all the way down 20%. And if they sold off beyond 20%, the position would no longer be hedged and the losses would begin to accelerate again. So just taking a look at the position unhedged in between the 5 and 20% sell-off, you can see the numbers there. And now let's take a look at it hedged one more time, just so you have something to compare that against. Yeah. So considerable cushion when we look at the profit and loss diagram if the Qs were to sell off anywhere between 5 and 20%. So this strategy is best used when you expect a moderate price pullback within a defined time frame. If you expect a market crash, you want to buy puts outright as they will make more money than a put debit spread will. It can serve as a temporary hedge against long stock or leaps positions, and that is the application that we just looked at in the previous example. And this is especially when you want protection for a specific time frame without committing the capital that you would otherwise for buying puts outright. So here are your key takeaways. The bear put spread is also widely known as the put debit spread. It gives you exposure to the downside, limits risk, and removes the need for high margin short positions. It's also a gateway concept. Understanding how debit spreads behave is key to mastering more advanced structures like ratio spreads, backspreads, and other strategies. If you found this video helpful, please let me know in the comments. And if you'd like to collaborate with other serious traders, you're welcome to join my DITM 2.0 community. Thanks for watching, and I'll see you in the next video. This video is for educational purposes only and does not constitute investment, financial, or trading advice. No recommendations to buy or sell securities are being made. All examples are hypothetical and for illustration only. All investments carry risk, including the possible loss of principal. Options trading involves significant risk and is not suitable for all investors. Past performance is not indicative of future results. Consult a qualified financial advisor before implementing any strategy and review your financial situation, risk tolerance, costs, fees, and tax implications. Options trading requires broker approval, and not all strategies are permitted in all account types. Returns shown are hypothetical and not guaranteed. Market conditions can change quickly, and results will vary based on market performance, timing, and execution. Read characteristics and risks of standardized options from your broker or at www.optionsclearing.com before trading options.